And in this video, we're going to speak a little bit about how to effectively use our zones in your trading. And remember, it all comes back to creating a frame of reference, and that's what our zones do for us. They provide us with a frame of reference in terms of where wholesale and retail value lie in the market, where previous areas of supply and demand imbalance are located in the market. It's all about identifying these important zones of price in the market where we want to do business, trades that and opportunities that make good business sense. And the purpose, our goal is to be able to identify the playing field, our landscape, if you will. And that's what we use our zones for, to help us maintain that broader perspective, to help us prepare our if-then scenarios, to make us aware of where value lies in the market, where supply and demand zones lie in the market, where the unfinished business, the areas of very obvious imbalance are located. All very important pieces of the context. Another thing, guys, that we always want to be aware of is news coming out, whether that means a scheduled economic number coming out or about to come out, or unannounced news, unexpected news, or a rumor coming into the market. These also affect the context of the market. So if we're going to trade and unexpected news comes out, we're going to look to close that trade out to control our risk. If we're scalping and we know there's an economic number about to come out, we're going to remain flat through that number. Okay, we're not going to pay attention or rely on any zones that are in the immediate area in the face of news coming out, because when news comes out, it creates a very intense, at times, imbalance in the market, which can propel the market forcibly in one direction or the other. So there's really three main types of entries that we can classify our trades into. One of them would be stepping in front of vertical development in one direction or the other. So the market's kind of at the edge, so to speak, of most recent market activity. And you see a good example of that this morning as the market was coming into our zone in the 1400 area. We're getting ready to look for a shift in the order flow. We're looking for an imbalance in the order flow to occur, and we start to see buy pressure diminishing as the market's coming up here. So I'm not going to get deeply into what we're looking for in the order flow, but just that we're looking for a shift in the order flow and the imbalance. So there's two ways to get into the trade here. One entryway, which in some instances might be considered more aggressive, but if you have other information that would already have you interested in stepping into the market at these points, this zone is adding to that confluence, that confirmation. But the market's coming into the zone, you get in front of what we call the vertical development to the upside, looking for that shift, that change to come in the market to start to sell off. The change meaning that this up auction turning into a down auction. So you're getting in an optimum trade location. The second way to enter this trade would be you're looking for the same shift to occur, but you're not willing to step in front of this vertical development. You're looking for a sell response to come in first. So we look for what we call a value transition. So it's the same trade. You're looking for the same, the purpose for the trade is the same. You're looking in the same area, but you're looking for a little bit more confirmation. In this instance, we would look for what we call a value transition. So we have our zone up here already. It's been there. But now what we have is a new zone forming in here. And what we would do is we would draw our zone and then look for the market to break the zone and look for an uptick back into it and take the trade here. So you're waiting for a little bit more confirmation. Both of these two trade entries out of the three different types of trade entries would be what we classify as outside-in type of trades. The market's moving to the outside of the most recent range. We're looking to fade that move back in towards the mean, back in towards the middle of the range from where it came from. The third type of entry that we see would be a pullback. Identifying a trending type of market, a condition where maybe it's a one-way type of day, and instead of looking to get in front of new highs, looking to buy pullbacks. Now, we're not going to look to buy those new highs. We don't want to buy new highs and get stuck in at retail pricing, and then when the market pulls back, winds up stopping us out, only to see the market turn around and make new highs, right? We've all been there. Instead, what we're going to do is we're going to trade like the smart money, like we always do. And what the smart money does, if they have a bullish bias here, and I'm kind of taking this out of context, but this is real time here, and I'm just going to make believe and say, we had a bullish bias here. We're not going to be looking to buy new highs. What we would be looking to do is buy a pullback into wholesale value, into either an area of unfinished business, which we will get into in a later video, or down into our next zone, our next demand zone. Now, what this is waiting for the market to pull back in and then look for a trade back out to the outside of the range, back to the outside of the edge. So this is an inside out trade, right? So we have outside in type of trades, back in to the mean, and then we have our inside out type of trades, which is taking a trade when it comes back into wholesale value and going for a move back up to challenge recent highs or maybe make a new high in the situation. Now, another way in which we use our zones for is profit targets, right? Let's say we did get short in here. We're looking for the market to sell off, whether we got short in here or we got short on the value transition setup, which was right in here. Where's your profit target going to be? Well, for us, if we're scalping, obviously we're going to look to start to book some profit right away and hopefully catch maybe a runner into deeper targets. But if we're looking for a deeper target right off the bat, we're not interested in scalping any quick profits. Where's our deeper target going to be? Well, our first logical spot is going to be at our next reference points to the downside, right? The same spots where we might be looking to go long are spots where we're interested in becoming a buyer, right? So if we're interested in becoming a buyer, that also pertains to being a buyer to close out shorts, right? So if it makes sense to be a buyer in this area here because of the area of unfinished business that we have that the market's coming into now, because we have the zone right below that, it's kind of what we call stacking the odds here for a bounce to the upside. This is a logical place to look for to take profit at a target area. We got to think about the market in terms of price being almost like a pinball. And what the market's doing all day long, throughout the day, every day, is going from zone to zone to zone. And if it gets into a zone, finds supply in here, resistance, and starts to head the other way, as this continues in this direction, where's the next logical spot for this market to react would be in our next area of demand, our next zone. So that's going to be another way to use our zones as profit targets. Third way to use our zones is for stops, for risk definition. Any trade that we get into, before we get into that trade, we have to be able to define our risk. We have to, be able to clarify, when do we know that we'll be wrong, that we don't want to be in this trade. Now, for me, I'm not a big fan of putting close, tight stops in. Doesn't mean we can't identify an area that if the market gets into, we don't want to be short anymore. So let's say we get short here. We could say, all right, if the market continues going and breaks through the next zone, we can put our stop above there. That's one way, a very visual kind of stop placement, risk definition. The other way is if we say we get short on the pullback here into the value transition short. If we get short here, where can we put our stop? Well, it would be kind of close in this case, but we could say, all right, let's put our stop just above the top of the zone, giving room for the market to probe up a little bit, maybe 2 ticks, 3 ticks above the zone. What I like to do personally is look for price acceptance. So I know that if the market gets up to 14.5, 14.00.5, I don't want to be long anymore, but I don't want to just see it tap there and then turn around and hit the other way. I want to see it tap there, maybe go to 3/4, back to a half, show that it's getting accepted up there, and then look to get out of the trade. But that's up to you. That's personal preference and how you want to manage your risk. Perfectly fine if you want, put a hard stop up there, and if it hits the stop, you're out. But it's a way to define your risk. Okay, guys, in our next video, we're going to talk a little bit about what our perfect zone might look like. The anatomy of a perfect zone, we'll call it.